In this re-upload, I'm going to explain why I love trading supply and demand zones, why I think it's the best trading strategy, and I'm going to show you how they work, why they work, and I'm going to give you some good tips led by proper trading examples. I'm going to go over on the charts from actual trades that I have taken to show you how you could add this to your trading strategy. It provides another tool which enables us to take high quality setups that offer proper risk to reward ratios. Before we get into it, if you are new to my channel, I would appreciate it if you could subscribe. And also, if you haven't followed me on Instagram yet, at Ameritrade, I'll post a link in the description below to follow me on there. I definitely recommend it. I post daily trading recaps along with very good trading tips and tricks that I guarantee you're not going to find anywhere else. The link will be in the description below. You're seriously missing out if you're not following it. But now let's get right into this video. So the first point is supply and demand is how the market auctions. It's how it facilitates trade. The market moves because of supply and demand. It's economics 101. For us to have a supply zone, we have a sell order imbalance based on where supply exceeded demand at the origin location. In this case, we're going to look at the NASDAQ. Supply and demand works on any market, any stock, any future, crypto, Forex, it does not matter. And it is different than support and resistance. This is an area where we had a sell order imbalance where supply once exceeded demand. In this area over here, a day later, the market came back into it and sold off. The same thing for the demand side. Demand equals a buy order imbalance based on where demand exceeded supply at the origin location. And this is where we're potentially looking to be bullish on the market. In this case, we had a demand order imbalance down here. The market sold off from that supply zone, hit that demand zone, and rallied towards the end of the day. This is different than a support zone or an area of support, because this is based off of an order imbalance. This is an area based on where demand exceeded supply at one origin point. So that's point number one. It's how the market auctions. It's how it facilitates trade. The market usually moves from imbalance to imbalance, whether we're talking about higher time frames, whether we're talking about shorter time frames. It's essentially how the market moves and transitions, even from balanced periods to imbalanced periods. It's not a coincidence that these are areas that the market has a hard time getting above or below, and it's very, very powerful. Now with this, supply and demand gives me structure. What I mean by this is obviously demand, we look to play the market long, and supply, we look to play the market short with some exceptions. But I see a lot of traders buying or selling for random reasons. Now let's just act like, let's go to a 5-minute chart. Let's just act like we did not have supply up here and we see the market moving up and then immediately coming back down, right? If you're a trader that has no structure, you're what I consider to be a gambling trader, where you're buying and selling based off of no reason other than the market's coming down, or you're buying because of no other reason that the market's coming up. That is gambling. There's no solid thesis. You have no reason to enter the trade because you can't give a reason why you should be entering in the first place. For example, let's just say, the market's coming down. We look to sell the market in this area over here, stop above the high. Our risk to reward is really not favorable, but we're selling the market just because we see it coming down. Yes, this trade could have worked out, but in the market, there's not going to be any longevity in that for you entering or exiting based on random points on what you think is going to happen. Because if you think something's going to happen, that's an emotion and that's a thought, and that's not a valid reason for you to enter a trade. So supply and demand, let me do this. Supply and demand gives me structure. It gives me areas that I'm looking to be a participant at. And it says, okay, look, the market's rallying inside of supply. This could be an important turning point that the market may have a hard time getting above. And we're going to look for some type of selling activity to potentially play the market to the short side. And as it's coming down, now we can look to play the market short because we have a reason to. Our reason, and it's not good enough just because it's coming down. When we add supply, when we add demand, when we add key levels, this just gives us a thesis, and this just makes us a valid reason to enter the trade. So it gives me structure. If you're watching this and say, what is structure? It's basically the market's very unstructured, but we have to make it to a point that when we see something that fits our edge, that we know works for us, that's our structure, and we take trades based off of that. I see many new traders, like I just said, they don't have a solid reason for entering, and there's not going to be any longevity in that, and they eventually blow up and destroy their accounts because I hate seeing that because it's something that can be prevented. These zones also provide me with clean and clear levels of interest. I want to make it clear that we don't always buy when it hits demand, or we don't always sell when it hits supply. We could use zones as context because not every zone will also provide a reaction. Going back to that NASDAQ example, let's just say we were in long earlier in the day, we're in long down here. We can maybe use supply as our target instead of maybe looking to take a new short position at supply. Or if we aren't in long and we get proper confirmation, we could take the market short at supply. Or if we took it short at supply, or we are that gambling trader, and let's just say we took it short for no reason down here, it wasn't based on our edge, maybe we could look to target demand. Instead of looking to play long at demand, we're using it as an area that we use as a target. So these are just levels of possible interest. Not every zone provides a reaction. I'm going to show you that. These are just levels that I'm interested in trading around. I use price and volume combined with market context to enter a trade at a zone. I cannot say how key that is. I don't enter randomly when it hits a demand zone. For example, let's go to today's action. The time I'm recording this, we'll use the S&P 500 actually. So we had a demand zone right here. This is why we don't buy when it solely hits demand. We must use price and volume to confirm it. The market all day putting in lower lows, putting in lower highs. We hit a zone and have no reaction from buyers at all. It's safe to say buyers are not factored in here. They're not buying at lower prices. They're not accepting lower prices. And we only want to trade on the same side as buyers if we're looking to play it to the long side. So I would have avoided taking it long at this demand zone. Same thing with this one. Absolutely no sign of buying. Completely came right through it. And we did not provide a reaction at it. And it came until the 4263 zone where volume started to build. We started to see some nice green activity and some nice order flow to confirm this trade to the long side for a potential 70-point rally after the previous two demand zones did not work. So you must use price and volume combined with market context for your confirmation to enter a trade at the zone. To simplify this, I look at it like this. Supply and demand zones give me my theory. They're my where I'm interested in trading at. Just because we have supply doesn't mean I'm looking to take the market short. Just because we have demand does not mean I'm looking to take the market long. It's a factor that, hey, we are rallying inside of supply, or hey, we are selling off into demand. This is, okay, I have an alert set. I'm watching to see what price does here, and it's going to give me, or if it does give me some type of indication or some type of clue, then I may take a trading decision off of that. Price and volume is my execution. It tells me when and why I want to enter the trade. So think of it like that. Supply and demand zones are my where. Price and volume tell me when and why. Without my theory and without my execution, I do not have a valid trade, and I will not put a trade on for no other reason than that. Fourth point is very key because supply and demand is a very powerful trading strategy, which could be used as a core for other styles and techniques. Don't think of supply and demand as a strict sole, I'm only doing this and I'm only going to get that out of it. I look at supply and demand as a core, or look at it as like a tree trunk, and other techniques or styles could be the tree branches stemming off the tree trunk, which is the core of supply and demand. So think of the trunk as supply and demand, and the other branches are other possible trading strategies that you could bounce off price imbalances and have this confluence for a high quality trading style, technique, strategy, whatever you want to call it. So we have an example on the S&P 500. This was a trade on February 22nd. I posted this in the Discord, and I basically said that we had a 4316 area where there were some large sellers trapped at. As long as this area gets defended and we could hold above it, we may balance or rally into supply near the highs. However, if 4316 does not hold, a move into the 4295 and 428 demand zone is very possible. This is where context comes into play, and this is where using price and volume analysis with supply and demand is very key. So we had a supply zone in this area that formed intraday from this failed rally to the upside and the sell-off. We also had confirmed from order flow sellers which were trapped earlier at the lows, which now coming back down into what we would want them to start seeing pressure to the downside. So at that point, I put the update in the Discord. Now that we have the context of sellers factored in at the high from supply that formed, sellers down here that we want price to get below 4316. If we could get below it with aggressive selling pressure, then it's very possible that these demand zones are going to act like magnets. Again, there are many ways you could use supply and demand as a core to come up with quality trading setups. Eventually, as we were below 4316, sold off into demand, found no buyers, continuously put in lower lows, continuously put in lower highs, and found the bid near end of day, like I said earlier, for a 70-point rally off of that demand zone. So now, since we are below these demand zones, these are all invalid. I will say, I draw every zone manually. I do not use any indicator to draw them. The human eye is the best component to drawing zones because it's very subjective and it's also based off of context. Supply and demand offers extremely low risk and very high reward. The risk to reward ratio trading supply and demand is extremely favorable if we time it right. Ideally, you want to shoot for at least a 2-to-1 risk to reward ratio. 3-to-1 is even better, so we could afford to lose a lot more times than we win, yet still make money. With proper confirmation, we could get this tight risk, and it's a good chance that we could enter a position at least near the best price point with a high probability of working out, and that gives us minimal risk. You really can't beat the risk to reward ratio if you time it right and leave your emotions off the table. So this is the example from the previous day, from that seller when the market sold off. Like I said, we created supply near the highs, and we also, from this sell-off, created supply to the downside that looks like this. Fast forward to the next day, we could extend it to the highs. We rejected it overnight, and look what happens when the market opened up. I personally did not take this trade to myself. I know a bunch of members in the Discord took this and completely destroyed it and made a lot of money. But if you look, the market opened up and we rallied into the zone 3 different times, and every time we came into it, we failed. If you were watching the tape at this time, there were some large aggressive buy orders coming through at 43.35 on the S&P 500, and price could not move any higher. There was a very large passive seller absorbing all those aggressive buy orders, and it took him 3 different times, and he failed every single time at it, indicating a very weak tape and a very strong seller factored into the market. You wait for heavy selling pressure to come into the market, then you could play the market short. Let's just say we got short up here when we started selling off, I don't know, at 43.30. Our risk in this case would be about 5 points. We're risking about 5, which means we need to make at least 15. Low a day is about 10 points away, and the nearest demand zone, the market doesn't always work this perfect. It does not always work this perfect, but the nearest demand zone was 60 points away. Obviously, you wouldn't have held to the full target, and you would have taken, I'm sure, some profits off, maybe below pre-market lows, or maybe below the action, the close from yesterday. But as long as you make your 2-to-1, 3-to-1 risk to reward, look how tight that risk was. And it offered 3 different chances for you to get short, broke the wedge, failed at it perfectly. Maybe you could combine higher lows, lower highs, sold off, aggressive volume coming through, and then a boom, nice lower low, lower high sell off for at least a full another 2 hours after that. So low risk, very high reward. And another thing that I like, and I find it to work out the best, is supply and demand. I've back tested it, I forward tested it, and it fits my personality. It's how I trade every single day. It's what works for me the best. It's how I consistently make money in the long run. It might not work for you. It might work for others. It works for me the best, and I can only explain how I trade and why I trade. I prefer buying when others are selling, and I prefer selling when others are buying. Think about it like this. If 90% of retail traders fail, do with what other traders don't do. A lot of traders are buying high at day breaks, selling low at day breaks, and they're getting completely trapped. When you combine the context of supply and demand, for example, this is a trade that I actually took. A lot of traders were getting long on this rally. Let's just say we don't know supply is here. We're long on this rally, and we're buying basically at the top. If we knew supply and demand, there is no shot I am buying near the highs up here. In fact, I might be looking to sell it. Then the market came up, broke the high, and failed to stay above that high, and I took the market short, stop above the high, target at demand, broke below VWAP, hit demand, and then bounced towards end of day. I like selling when others are buying. If 90% of retail traders are wrong, I like doing what they don't do, and I like doing what the opposite does. That's how you gain an edge in itself. So I shorted, I played puts at this high a day break, stop above the high, and worked out extremely, extremely well. So it's just how the market moves, understand the mechanics behind it. I could show you 100 different charts. Go through my old videos on my channel, go through them all. There's a lot of different explanations. I could show you 100 different charts. It's how the market works, and it's my favorite trading strategy. I only use this, price and volume. So I hope this video helped. If it did, drop a like, comment if you have any questions. I'll go through all the comments, and check out the links in the description below. Peace out.